Okay, let's jump in. Today we're looking at Kirkland's Inc., specifically their fourth quarter and full fiscal year 2024 results. That year ended back on February 1st, 2025.
Right. And there's quite a bit to unpack. Sales, margins, what's happening with their stores, their debt situation.
And importantly, some big events that happened after the year ended, plus what the company and analysts are saying about the future.
Exactly. So if you're interested in the home decor retail space and how companies are navigating it, well, this is definitely relevant.
Absolutely. And hey, before we get started, if you find this valuable, please take a moment to like and subscribe. It really helps us out.
It does. Okay, so kicking off with the fourth quarter of 24.
Yeah. Net sales landed at $148.9 million.
Which was down from $165.9 million in the fourth quarter of the previous year.
We should remember, though, that prior year quarter had an extra week in it.
Good point. That definitely skews the comparison a bit.
So looking at comparable sales, which adjusts for things like that extra week and store closures,
Yeah.
how did that look?
Consolidated comps were down, but only slightly 0.6%. It's kind of a mixed bag within that number, though.
Oh, how so?
Well, comparable store sales, the physical locations, were actually up 1.6%.
Okay, so positive momentum in the stores.
Right. But e-commerce sales fell pretty sharply, down 7.9%. So that really pulled the overall comp number down.
Interesting. So strength in physical retail, but weakness online.
Yeah.
What about profitability in Q4? Gross margin?
Gross profit margin was 30.3%. That's down from 32.0% in the prior year.
Any particular reason for that dip?
Yeah, mostly lower merchandise margins because they ran more promotions, trying to drive sales. Plus, some deleverage on store occupancy costs.
Makes sense, lower sales volume against fixed costs like rent.
Exactly. But it was partly offset by lower outbound freight costs, which helped a bit.
Okay. And the bottom line, operating income and EBITDA.
Operating income came in at $9.2 million, down from $10.7 million. And adjusted EBITDA followed suit, $12.0 million versus $14.2 million previously.
Still profitable in the quarter, but less so than the year before. Did they make changes to the store count?
They did. 1 store opened, but 9 closed. So they ended the quarter and the fiscal year with 317 stores.
Got it. Let's broaden out then to the full fiscal year 2024. How did the annual numbers stack up?
Full year net sales were $441.4 million. That's down from $468.7 million the year before.
And again, that prior year included the extra 53rd week.
Correct. For the full year, comparable sales decreased by 2.0%.
Similar story to Q4 then, with the different channels.
Very similar. Comparable store sales were actually up 1.9% for the full year.
So positive comps in the physical stores for the whole year. That's notable.
It is. But again, e-commerce really struggled, down 12.9% for the fiscal year. That's a significant drop and pulled the overall comp down.
That online weakness seems persistent. What about the full year gross margin? You said Q4 was down. How about the year?
Actually, for the full year, the gross profit margin improved slightly. It went up to 27.6% from 27.1%.
Oh, okay. Why the improvement year over year when Q4 was down?
It seems like benefits earlier in the year, or maybe just over the full 12 months, outweighed the Q4 pressure. They cited favorable outbound freight, distribution center costs, and depreciation.
But still facing some headwinds.
Yeah, partially offset by that same store occupancy deleverage and lower merchandise margins we saw in Q4.
And the operating result for the year.
An improvement there. The operating loss narrowed quite a bit to $14 million compared to a $24.4 million loss in fiscal 23.
Okay, moving in the right direction on losses. Adjusted EBITDA.
Also improved. The adjusted EBITDA loss shrank to $2.3 million from an $8.4 million loss the previous year.
So still loss on that adjusted basis, but significantly better. And store changes over the whole year.
2 stores opened during the year and 15 closed, which, as we said, resulted in that 317 store count at year end.
All right, let's shift to the balance sheet as of the end of the fiscal year, February 1st. What did inventory look like?
Inventory was up $81.9 million, which is a 10.5% increase from the year before.
Why the increase?
Well, the company said it was partly planned they wanted higher levels, but also because sales, particularly in Q4, didn't move through inventory as quickly as they'd hoped.
So maybe a bit more stock than ideal heading into the new year. What about cash?
Cash balance was quite low, $3.8 million.
And debt.
They had $43.0 million drawn on their revolving credit facility and also owed $17.0 million to Beyond Inc.
Beyond Inc. We'll definitely come back to them. How much borrowing room do they have left at that point?
Only about $4.3 million available under that revolver, so not a lot of immediate wiggle room there.
Okay. Now, you mentioned subsequent events. Things happened after February 1st. Sounds like some important financial moves were made.
Yes. Quite a few. Just days after the year ended, on February 5th, an $8.5 million convertible note held by Beyond was converted into Kirkland stock.
So debt became equity.
Right. And on the same day, Kirkland's got another $8.0 million in equity financing, also from Beyond.
So a significant cash injection and debt reduction, essentially, through Beyond's investment.
Exactly. It definitely shored up the equity position.
Any other moves with their main credit line?
Yeah. After February 1st, they made net repayments of $4.1 million under the revolver. But they also issued $5.1 million in letters of credit, which ties up availability.
Okay. And was there more financing potentially coming from Beyond?
Yes. As of late April, they were in talks to finalize another $5.0 million from Beyond, this time under their existing credit agreement.
What's that $5 million intended for?
General working capital, but also significantly to fund the start of converting some Kirkland stores over to Bed Bath & Beyond Home and Overstock banners.
So that's part of the Beyond strategy taking shape. We need to dig into that partnership more. What was the debt picture as of, say, May 1st?
Outstanding debt under the revolver was down a bit to $38.9 million, plus those $5.1 million letters of credit were still out. Availability was minimal, pending the close of that expanded term loan from Beyond.
Okay, so heavily reliant on that Beyond financing coming through. Now, amid all this financial maneuvering, there was some pretty stark language in their filings, wasn't there, about going concern?
Yes, that's a major point. Kirkland stated that their upcoming 10K filing would include details on mitigating tariff impacts.
Right, tariffs, especially from China, are a big issue for home goods retailers.
Definitely. And their cash flow forecasts account for the financing they've secured and expect, plus cost savings and profitability improvements. However,
Here it comes.
they explicitly stated that uncertainties around tariffs and the general macroeconomic conditions raise substantial doubt about the company's ability to continue as a going concern for at least the next 12 months.
That's serious language from a company. Substantial doubt.
It is. And that situation, that uncertainty, actually caused them to fall out of compliance with some covenants in their credit agreements.
Routines.
Technically, it allows lenders to demand immediate repayment, so all the outstanding debt gets classified as a current liability on the balance sheet.
Not ideal.
Not at all. But they did say they expect to get waivers for this non-compliance as part of finalizing that new financing from Beyond. It shows how interconnected everything is right now.
Wow. Okay. So significant financial pressure despite the improvements in operating loss. How is management framing all this? What's the strategic direction, according to CEO Amy Sullivan?
Well, she characterized fiscal 24 as a really important year in their transformation, highlighting progress in revitalizing the Kirkland's home brand.
Through what kinds of initiatives?
Things like re-engaging customers, tweaking the product assortment, maybe getting it more focused, and boosting their omni-channel capabilities.
Trying to bridge that gap between the stronger store performance and the weaker e-commerce.
Exactly. And she credited these efforts for that positive brick-and-mortar comp growth and the improved bottom-line performance, like the smaller operating loss.
And the partnership with Beyond. How do they view that?
As crucial, opening up new growth avenues, a chance to sort of reimagine the future for both companies.
So the current focus is on navigating those tariffs you mentioned.
Right, navigating tariffs and accelerating what they call a capital light store conversion strategy.
Using the different brands they now have access to?
Precisely. Leveraging Kirkland's Home, Bed Bath & Beyond Home, and Overstock, they've apparently already identified the first potential locations for conversion to those Bed Bath & Beyond Home and Overstock banners.
What's the hope for those conversions?
The idea is they'll drive brand awareness, bring in new customers, and generally support the turnaround effort. The overall message is focus on results, getting back to profitability, and driving shareholder value.
Okay, that's the company's perspective. What are market analysts saying about Kirkland's stock ticker, KRRK?
It's interesting. According to MarketBeat, based on just 2 Wall Street analysts covering it in the last year, the consensus rating is actually strong buy.
Strong buy, despite the going concern warning.
Seems so. One analyst has a buy, the other a strong buy.
What kind of price targets are they putting out?
The consensus target from those two is $4.50. The range is pretty wide, though a low of $2 and a high of $7.
Wow. Compared to the price around early May, which was about $1.16, that $4.50 average target implies a huge potential upside, like over 280%.
A very significant implied upside, yes. It's also noted that their strong buy consensus is better than the average moderate buy for the retail wholesale sector. And there was one analyst upgrade in the past 90 days.
So a disconnect between the company's own warnings and the analyst's optimism, at least from this small sample. What are some other key metrics for context?
As of early May, the market cap was tiny, around $15.2 million. Trailing 12-month revenue, as we discussed, was $441 million. Net income was a loss of $23.1 million, or negative 1.77 per share.
And the store count slightly updated.
Yeah, the data mentioned 314 stores operating in 35 states, so maybe a few more closures right after the fiscal year end, plus the e-commerce site.
Okay, let's dive deeper into that partnership with Beyond Inc. It seems absolutely central to Kirkland's strategy now.
It really does. So the deal includes Kirkland's operating up to 5 small format Bed Bath & Beyond stores. They'll be the exclusive operator and licensee for those.
Small format, interesting. Not the big boxes of the past.
Right. And there's also the possibility of Bed Bath & Beyond shop-in-shops inside existing Kirkland stores.
Leveraging their current footprint. Is there a financial arrangement beyond the investment?
Yes. Beyond gets a collaboration fee. It's 0.25% of all of Kirkland's quarterly retail and e-commerce revenue, and that's for 7 years.
So Beyond gets a small slice of all sales. And remind us about the investment.
Beyond put in $25 million back in February, which gave them about 40% ownership of Kirkland's common stock, a very significant stake.
40%. Okay. Have they started on those store conversions yet?
They've identified the first location for a Bed Bath & Beyond home conversion, apparently in Nashville.
And what about the Overstock banner?
They're planning dedicated Overstock stores, too. And the projection, or maybe the hope, is that these could deliver at least twice the revenue of a current Kirkland store.
Double the revenue per store. That's ambitious.
Very ambitious. It really shows how much they're betting on these new formats and the Beyond partnership to turn things around.
So, wrapping things up, we've covered Kirkland's recent financials, the struggles, especially in e-commerce, but also some improvement and losses and positive store comps.
Right. And then the huge strategic shift with the Beyond partnership, the investment, the store conversion plans.
All set against that backdrop of the going concern warning from the company itself.
Which contrasts sharply with the very bullish, albeit limited, analyst view suggesting significant upside potential. It really highlights the uncertainty.
Yeah, the whole home decor sector is shifting, and Kirkland's is making some bold moves with these partnerships and conversions. But those tariff and consumer behavior risks are very real.
It really poses the question, can the potential growth from these new ventures outweigh the immediate financial fragility and the external pressures?
What do you think will be the most critical factor for them in the next year? Is it successfully launching these new store formats, stabilizing the core Kirkland's e-commerce, or just navigating the finances day to day?
It feels like all of the above, really. They need the Beyond partnership to deliver, both financially and strategically with the store conversions, while also trying to fix the online side and manage cash carefully. It's a complex balancing act.
Definitely a story worth watching closely as it unfolds.
For sure.
Well, that brings us to the end of our analysis today on Kirkland's. Thanks for tuning in. And one last reminder, if you enjoyed this discussion, please like and subscribe. We'll catch you next time.
Thanks, everyone.